All right, cool. Okay, welcome everybody back to the Bookkeeping Academy for VARC Solutions. We're going to talk today specifically on the topic of inventory versus non-inventory. I've got a couple comments and notes on that specifically that I want to go through, and then if there's any questions, we can address those and discuss those as a team. QBO is down right now, so I'm going to be using the desktop version to kind of show and tell. But the concepts of what we're going to talk about apply to both. Just the windows look a little bit different. Obviously in QBO, when you set up a product or service, you can choose a category or type, and inventory is a type, non-inventory is a type, service is a type. And so we're just going to touch base on the differences between inventory and non-inventory specifically. But again, a lot of the things, even though I'm going to show you desktop on this one, the concepts still apply. Okay. In fact, so let's do this. I am going to show my screen here, and I'm going to talk through, hopefully without showing the wrong thing this time. I'm going to show this screen. Everybody should see the document I've got over here, Bookkeeping Academy, inventory versus non-inventory. If you can't see that, let me know.
Looks good to me.
All right, perfect. So really, so why are we talking about this? I think sometimes it's because our clients and customers that use QuickBooks, they might be set up items the wrong way or products and services the wrong way. Maybe they set something up as an inventory part that really shouldn't be an inventory part. Sometimes they might ask questions, why am I not able to track quantity on hand or see that, or maybe the quantities on hands are always wrong and I don't understand why. And it could be that they just set up the wrong type. They might have set something up as inventory that should have been non-inventory or vice versa. So let's just talk about the basic categories first. Inventory, as a general rule, are things that you buy and sell and track quantities on hand for. Okay. So when I buy that inventory, it's increasing the quantity on hand. When I sell it, it's decreasing the quantity on hand. And if I went into my item list in QuickBooks or my products and services list in QuickBooks Online, I should be able to see right now what my quantity on hand is and go count that stuff. And if it's wrong, I can go fix it and make adjustments and things like that. But when you buy it and sell it, it adjusts the quantity on hand if it's set up as an inventory part. Non-inventory, however, is still typically things that I want to. I mean, it's not a service, right? It's not just a fee that I'm charging people for. It could be a product that I'm selling, or it could be a product that I'm buying. But when we think of that in terms of how QuickBooks handles it, non-inventory are things that you buy and or sell that you simply don't or can't track quantity on hand for. One of the examples I use is, like a golf store, a golf shop. I might have inventory set up for my golf clubs and my really expensive things that I literally need to track quantity on hand for. But, if you've ever gone to a sporting goods store and you've seen that big bucket, as you're exiting the store, and it's got like it's got golf tees in there, and there's tens of thousands potentially of golf tees in there, but they're not actually inventorying every 10,000, one of those golf tees. It might be something they set up as non-inventory part because, yeah, they do buy it. Yeah, they sell it, but they don't ever go count it, and they don't ever really go looking and seeing, okay, I've got 9,776 versus, 9,625, right? They're not going to count it. Okay, I've got another example that might be less sporting goods specific here in a second, but just that's one of the concepts. The other concept with non-inventory is it also is very typically things that I buy but don't sell. Okay, so maybe I'm doing a PO to a vendor and I'm buying stuff, and I'm using that stuff within the business, but I'm not actually turning around and then selling it. And so you can imagine if you've got something that's a product that you're buying and you keep buying it and keep buying it and keep buying it, but you never actually sell it or record the use of it, the quantity on hand in theory would keep going up and up and up forever if it was an inventory part, and it would always be wrong. The same thing is true if you sell things that you don't buy. So maybe you make something, right? You never buy it, so the quantity on hand never goes up, but you do have this thing that you sell. And if it was inventory part, it would decrease the quantity every time you sold it, but it would never go back up to any a zero or a higher number because you're never buying it. Okay, those are the categories or typical reasons why something might be inventory or non-inventory. And I've kind of explained that a little bit in the document here. But let me also explain that there's an accounting impact here, which I think is important, especially as bookkeepers. And that is how the accounting behind the scenes is treated differently when you have an inventory part versus if you have a non-inventory part. So I'm going to pull up QuickBooks and basically try to explain that here. So again, I'm using QuickBooks Desktop because QuickBooks Online was broken today. Okay,
And it still is.
And still is. Okay, no problem. This is so what I'm going to do, I'm just going to pull up the item list in QuickBooks, which is comparable to the product and services list in QBO. And I'm going to go open up a brand new item. And I don't know if I can make this screen actually any bigger for you. I probably can't, but let me try, because I'm sure that's pretty small. Is that pretty small for everybody?
A little bit. Is it possible for you to stream like a program rather than the screen?
Yeah, that's what I'm going to try. Let me try to share a.
Oh yeah, see, Jennifer, I can get to the point where I can select a client, but as soon as I try to actually load into the client file, it gives me an error code again.
Okay, I'm going to see if I can share just part of this screen here. And if I can't, we'll just have to do it anyways. Let's see. Yeah, it doesn't look like I can share just part of the screen. At least I haven't seen how to do that. So should be able to see my QuickBooks screen here still. Okay. I'm going to talk through it. So if you can't see the details, again, I'll just kind of talk through it. So first off, let's do it with a simple example. I'm going to do a non-inventory part. So when you pull up a non-inventory part, okay, you give it a name, and so let's just call this a small widget, whatever it is. When you have a non-inventory part, there's really two components. There's a sales side and there's an expense side. The default is really actually just to show you the income side. So like, in other words, when you sell this thing, this small widget as a non-inventory part, what is the income account you want those dollars to flow to after you've done a sales receipt or an invoice? And so that would typically be some sort of an income account like product sales, widget sales, however you want to categorize that. And there's usually a sales description. So the only accounting part that's required, if you will, on that item is the sales side. However, if these are things that you're buying and there's a cost to them, you're going to want to check this little box that says this item is used in assemblies or is purchased for a specific customer job, which is also kind of deceitful because really all that the box should just say, I buy these. Because if you check that box, it opens up the cost side. And so we could say, well, we charge people $110, but it costs us $50. And the question is, what is the expense account that we want that cost to show up for when we write a check, when we credit card charge that, or when we enter a bill for that thing? And again, this is, you could make the decision on your side in terms of where you want that cost to flow. If it is a cost of the goods that you're selling, then it would be a cost of goods sold account, and you could have those dollars flow to something like COGS products. Or if you weren't tracking that specifically as a COG, maybe it'd be something like materials expense. Okay, those are judgment calls, but I would say generally we would say that would be a COGS product. Okay, now what's interesting about non-inventory parts is the accounting happens immediately when you buy it or sell it, right? In other words, if I was to put this small widget on a check, a credit card, or a bill, and I post it to that expense account, the dollars are going to hit that account immediately. They'll show up on financials on an accrual basis if you haven't even paid the bill yet. On a cash basis, it would only show up after you paid the bill. But the costs are going to flow to that expense account or that COGS account immediately. When I sell that item, the income is going to go straight to the income account immediately, okay, when I record the sale, okay? Now, that's how non-inventory part accounting works. There's an income side and there's an expense side, which again, we can flow to COGS, okay? Now, an inventory part is a little bit more complicated. So for example, when I go to my item list and I set up a new item, again, a product and service in QBO, and I say it's an inventory part, I'm going to call this a big widget because these are ones that I track quantity on hand for. And in that inventory part, I have a little bit more complicated accounting set of requirements. Okay, so I still have the income account. Okay, which again, I can go pull up my chart of accounts and I can say this is product sales income. So when I sell that thing, that's where the income goes. But when an inventory part is set up, there's actually two additional accounts that you have to specify. One is the COGS account, and the other is the inventory asset account. So I'm going to talk through that, but just to get the form filled out, we've got the income account filled out for product sales. The asset account, we're going to use inventory asset. And for the COGS account, we're going to use, in our case, I set this account just right before the thing, and I said, hey, COGS products. Okay. Now, the accounting is a little bit different, again, on an inventory part, because whereas on a non-inventory part, it's just got an expense, and when you buy it, it goes immediately to that expense account. The accounting for the inventory parts works differently. When I buy this big widget on a check, a bill, credit card, whatever, the cost of that purchase doesn't go to the cost. It actually goes to the asset account. Okay, it immediately flows to the asset account so that I can see that on my chart of accounts. I can see that on my balance sheet as an asset that's increasing when I buy those inventory parts. So the cost of that purchase goes there. When I sell the inventory part on an invoice or a sales receipt, that's when I record my income, but that's also at the time of sale when the dollars flow from the asset account to the cost of goods sold account. So in QuickBooks, that's usually the average cost. So the average cost of that item is being removed from the asset account and moving to the COGS or cost of goods sold account. Okay. So you can see how that changes the accounting because of the asset account and the COGS account treatment on that inventory part. Okay. Now that's some of the background on that. One of the other things and one of the distinctions that we make between QuickBooks Desktop and QuickBooks Online that I think is important is how this maybe relates to inventory and inventory assemblies. You all should probably know that QuickBooks Online doesn't do inventory assemblies. Like you can't buy components and then turn them into a finished good like you can with QuickBooks Desktop. Okay, so in QuickBooks Desktop, you can actually do an inventory assembly, and it's a different type of item. And that's where you could put in the actual components, and then you could turn that component into a finished good. The reason I point that out is because in QuickBooks Desktop, the components could be set up as inventory parts, even though you're not selling the individual components. Okay. In other words, you buy these individual parts that get built into this finished product. When I buy those individual components, I could see the inventory part quantity going up. But even though I'm not selling the parts, I can then go do what is called a build assembly, which takes the inventory components out of on hand and it converts those into the finished product, which is something that I then sell. So when I build the assembly, it decreases the quantity on hand for the components. And when I build the assembly, it increases the quantity on hand for the finished good. Okay, So that's something that it works in QuickBooks Desktop, but if you're in QuickBooks Online, since you don't have the ability to do assemblies, it's best to treat all those components as non-inventory parts. And quite frankly, the things that you're selling probably should be non-inventory parts as well, unless you are doing the buying and the selling of that inventory part, so that you see the quantity going up when you buy it and the quantity going down when you sell it. That's a typical use case for that. So let me go ahead and pause right there. I'm going to pull up the chat window and just see if there's any questions or any discussions on any of that stuff. Any questions, any conversations related to that?
No, but I'm so glad this is recorded.
Oh, good. Fantastic.
I'm gonna probably listen to this like 2 more times.
Awesome. Cool. What kind of issues do you guys see, and just asking collectively the group, what issues do you see with clients specifically when it comes to inventory, non-inventory, inventory assets, COGS, things like that, as it relates to the products and services list or the item list in QuickBooks?
I personally don't have any clients that actually use that. I kind of wish I did now that so I could get some hands-on work on it.
Very cool. Anybody else encountering any issues with clients when it comes to the inventory stuff?
I think one of the main things you find is people miscoding their income, cost of goods sold, or asset account. So that in the background, as they're adding inventory or reducing it, it goes in the wrong places. And so they don't know how to fix it.
Right. So somehow the inventory on hand is getting messed up. And the accounting obviously related to that is also messed up.
Correct. And going back and fixing that, depending on how long it lasted, is sometimes a considerable issue.
Yep. So how do you figure things out like that? Like what do you look for, or what are the ways that you interact with the software to then resolve those kind of discrepancies? Is it journal entries, heaven forbid, or is it other, do you do something else?
Truly depends on how long. If it's an error that happened this year, going back and correcting the accounting behind it is typically just editing the account in the item and letting it fix historical transactions.
Mm-hmm.
But if it goes back several tax years, especially, then it becomes a little more of a, okay, do we need to go as far as zero out this inventory item, create a new one with the correct fix via journal entry? I mean, it can go pretty deep. It depends on how far it goes back.
Got it. In QuickBooks Desktop, since it does have a little bit more of an elaborate or robust inventory capability, with Desktop Enterprise Solutions, of course, with advanced inventory, it has even more, things like serial lot numbers, bins, warehouse, location tracking. I mean, there's a lot more you can do on the enterprise side related to that. One of the features that can be used on the desktop side is the adjust quantity value on hand capability. And also there is a inventory transfer type of thing too. So if I go to adjust quantity value on hand, like if I had a scenario where I've got these things that I need to adjust the quantity on hand for, like maybe I didn't record the purchase correctly, or maybe maybe it was set up as an inventory part and I bought it but never sold it, and I want to somehow adjust for that. I can do a quantity on hand adjustment, and I can say, oh, hey, instead of 0, we actually have 120 of those. Okay. And I can put in an adjustment account, which again could be a COGS account. It could be some other account, just depends on the scenario. But I can make those adjustments within the software. I can also do a value-based adjustment. In other words, I can leave the quantity alone, but I can say the value of it is different if I maybe again didn't record the purchase correctly or the sales correctly. So those are some things that we can do within Desktop to adjust quantity, value, effectively cost behind the scenes. if we need to. And of course, journal entries don't affect the actual items. They only affect the accounting. So if you do need to affect the items quantity on hand, okay, then the inventory adjustment is a really good way of doing it. Okay, cool. All right, any other thoughts before we end this session today?
None here, but it is still down.
QBO
And
is
it's actually gotten worse.
lovely, lovely.
Before it was just the United States, now it's extended to Canada and the UK.
Lovely. All right. Well, I'm going to go ahead and stop the sharing, and I'm going to stop the recording. I will, again, we'll share the notes with this, share the recording as well, so that everybody can watch that later if they needed to, and then pull up QBO when it's back online, and you can look at the products and services list in QBO, and you can kind of look at the same sort of settings for inventory parts, non-inventory parts. Again, the basic structures there, the window's a little bit different. You might have to scroll to get to the sections towards the bottom on the inventory parts, but it's all there. So thanks for joining, and hopefully this is helpful. Next week, by the way, we have a guest presenter. Brandon's going to be awesome next week, and we're going to be talking next week about how and why to close the books each month, because we know that's an issue with some of our clients, and it's something we should be doing anyways, either for our clients or with their coordination. So thanks for joining, and we'll talk to you next week.